Hello everyone, this is Jimmy Singh, broker owner of Supermax Realty. Welcome to my channel Real Estate Edge with Jimmy Singh. In today's video, I like to share my thoughts and go deep into some stats from the history. What happened to our greater Toronto real estate market, Ontario Canadian market in last 50 years, especially during turbulent times, recessions, bad economic situation, higher interest rates. Folks, for the last couple of months, I have noticed, especially in social media and in print media, people are blowing up negative news out of proportion. Real estate is always local. We have to see certain factors. What is the demography shift happening in the marketplace? How's the local economy? That will predict the desirability and need of housing. I remember when I bought my very first property in Hamilton in early 2000s, I invested close to the steel plant, Defesco, Stelco, we call, Hammer Town. So I bought as a rental property. At those time 100,000 get you a detached house, 3-bedroom, 2-washroom kind of house. And the Hamilton prices were stagnant and hit hard because of over dependence on one industry. If I talk about, for example, Oshawa, which is east in Toronto area, they have, again, automotive dependent. Windsor also for the longest time dependent on automotive parts. If I talk about London, London used to have a very big footprint of insurance company, back offices, head offices, and same thing, St. Thomas, south of London, was dependent on Ford plants and a lot of automotive plants. And if you go back, you see when these big companies leave these towns, it affects the price of real estate for a long period of time. And right now, what I want to mention is things have evolved. So all the people, all the fear mongers who are looking at the history of 80s, 90s, try to give us the lesson that we are heading to the same kind of recessions, or next 10 years is going to be all doom and gloom. Trust me, we are not in the same situation. Talk about Toronto, I don't see a recession lasting long time in Toronto. Toronto is very diversified. They have universities, employers in healthcare, they have top law firms, top insurance firms, top bank head offices, top colleges, universities, IT sector, transportation, you name it. Same if I talk about London area, we have diverse jobs. We don't depend on one industry anymore, though healthcare is one of the biggest employers, university is one of the biggest employers, but all of these cities have learned their lesson and they are diversifying big time. Now, another thing I want to talk about, folks, is lot of the boards every month come up with the stats. Toronto board come up with their stats. London, St. Thomas, Association of Realtors come with the stats. Kitchener-Waterloo come up with the stats. Hamilton, Burlington come up with the stats. Windsor Real Estate Board come with the stats. I read the stats, but I take them with a grain of salt. Let me explain. For example, if you have a very high-end area in a city where properties are million plus or maybe 2 million plus, if in a given month 7-10 properties are sold in a high price range, it will distort or skew the data for that particular month. For example, we talk about Toronto. Everybody knows one of the very sought after neighborhoods in Toronto where a lot of celebrities, sports people, businessmen live is Bridle Path. Average price point probably $15 to $20 million homes. So in a given month, if we have 7-8 sales, it will distort the average price point for Toronto area. If we talk about Oakville, Joshua Creek, or those kind of nicer areas, average price probably 2 million, 3 million, 4 million. If in a given month there's bunch of sales like that and less average homes, less than maybe 800,000, it will distort the data at a higher level. At the same token, if in a given month, for example, in London, we have more bungalows sold which are less than $500,000 and fewer $1 million plus homes sold, it will reflect in a board average price have come down from last month 50,000, 70,000. And they, media people and those newbie YouTubers, they take these data and blow out of proportion, try to create a panic. And I've been making videos long time since, last 2-3 years, talking about these things. So if you are buying a house as a primary residence and you have savings, you want to own for 5, 7, 10 years, that is the best way to go. There's no capital gains on a primary house and you can climb the property ladder. So it is very, very critical, guys, what kind of news you read. For example, I share another thing. Lot of agents in our office, lot of good brokerages, agents do lot of exclusive sales. Those are not reported on our MLS system. Exclusive sales meaning properties are not listed on MLS system. Maybe the seller want their privacy. Maybe sometimes sellers say, hey, if you have a buyer, bring me on. So sometimes we have customers, buyers, we take directly to the sellers, we make agreement of sale and purchase and then send to our lawyers, right? Especially we do a lot of pre-construction and a lot of agents focus on pre-construction houses and condos. Those sales are not reported on MLS systems. So whatever sales data you're looking at, the sales are down 40%, 30%, those data can be not correct. Another thing is, for example, in 1980, a lot of people folks making video, in 1990s, 1980s, people were walking away from properties, it was big mess and the interest is gone up. Folks, we are still sitting at 5.5, 5.8% interest. You go back in 90s, you're paying 15%. You go back in 80s, you're paying 22% interest. So all in all, it's not doom and gloom. How can anybody expect when pandemic, when people are getting mortgages at 0.99%? Some lenders were offering that. How can you expect a mortgage of 2% for next 30 years? See, folks, at the end of the day, if I take 80s or 90s, that time unemployment was in double digits. There's 13 to 15% people in Canada were unemployed. They can't find a job. Right now in 2022, I know a lot of business people, they have hard time finding employees. I have friends who own restaurants. I have friends who own garage. I have friends who own construction companies. They have a hard time finding people to work for them. 2020, people don't want to work, right? So that is the difference. In 1980s, 1990s, lot of, condos or houses, they were vacant. The vacancy rates were higher. These days, we are getting multiple offers in our rental properties. So we can't compare 80s, 90s and try to scare people in our videos, say, it's going to happen all over again. Yes, we can certainly learn from history, but I don't see this time history repeating itself. There's so many variables, there's so many dynamic things happening all over the globe. So we can't say it's going to, happen again. Another thing is, last 2 years, prices went up 46%. And at certain point, we need to, reset those prices because these are not sustainable. We can't have double-digit growth because historically in 30 years, we have single-digit growth all across Greater Toronto area. And eventually, I see a rental market, the prices will hit a wall. Just like, for example, if you're looking for a pre-construction condo in Toronto, average builders want to sell is $15 to $16, dollars per square feet. But in a resale market, if you can get a nicer condo for 1,000 or 1,100 square feet, that is a good deal. So what's going to happen is, if builders can't make money, they will simply stall the projects. And that is happening all across the board. We deal with a lot of builders. I'm looking at, detached houses, townhouses. They're just staying put. They can't afford to make and sell houses at loss. So if I see a long-term picture, maybe what's going to happen in next 5 to 7 years when things stabilize, we'll be again in the same situation with lack of supply and influx of 500,000 people coming into the country. It might take time, it might not happen overnight or in the next 12 to 18 months, which in my opinion are challenging for few folks. But all in all, if I look at the bigger picture, I see we will be fine. So again, guys, the purpose of this video is to make public aware. Whatever you see, you can't trust, because whatever headlines they are putting out there to scare you, you should be very, very careful. I'm working with at least like 8 to 10 people right now. They were supposed to buy early this year in February, March, but unfortunately their budget, for example, was 650 and the houses were selling at 850. Or somebody's budget was 8 and the houses were selling at million. Now the prices have come down and all these people are waiting for the opportunity. They might jump now, they might jump in 6 months, but what media doesn't tell you is people buy homes based on emotion and their desires. If you buy investment property, you look for cash flow, you look at cap rate and all the other dry stuff. But people buy irrespective of economic conditions. And I talk in my video, in 1976, when the market was really bad, that year Toronto Board reported 9,025 sales. In 1981, when the interest rates hit 22%, we have 29,625 sales. In 1990s, when it was really bad, that year we have 38,144 sales. Yes, prices have coming down, rates are going up, and at the same token, people who can't afford the houses, they jumped into it and start buying at their good locations, for their families. In 2017, again, Canadian, was a tough year for Canadian real estate. We have 92,340 sales. So all in all, folks, if I see my crystal ball in 2023, yes, we'll have a volatile market. Very probable prices will keep coming down since, they're increasing the interest rate. But one thing I can assure, we will have sales next year. Nothing is going to stop. It's just a matter of time. So if you're an investor, you have a rental property getting good rent, don't panic. Stay calm. You will be fine. Thanks for watching. This is your friend Jimmy Singh, real estate broker, Supermax Realty, 647-961-2639.